Myself Drishti Tammakola from class SY BCom, roll number 725. I am here to present a video on credit control. So what is credit control? Credit control is an important tool used by RBI, a major weapon of monetary policy used to control the demand and supply of the money in the economy. Central bank administer control over the credit that the commercial bank grant. Such a method is used by RBI to bring economic development and stability. It means that bank will not only control inflationary trends in the economy but also boost economic growth, which would ultimately lead to increase in real national income stability. In views of its functions such as issuing notes and custodian of cash reserve, credit not being controlled by RBI would lead to social and economic instability in the country. Objectives of credit control. The primary objective of credit control are to achieve internal policy stability, to achieve stability in foreign exchange rate, to achieve financial stability, that is stability in money market, to meet the financial requirement during slump in the economy, to eliminate business cycle and meet business need, to promote economic growth and development of the country, to maximize income, output and employment. Tools of credit control. There are two types of credit control. First, qualitative and second, quantitative. Qualitative method includes credit ration, direct action, moral prevention, publicity, consumer credit, marginal requirement. And quantitative methods include open market operation, bank rate, and cash reserve ratio. Qualitative or selective method of credit control. The qualitative or selective method are directed towards the diversion of credit into a particular uses or channel in the economy. Their objective is mainly to control and regulate the flow of credit into particular industries or business. First, rationing of credit. Under this method, the credit is rationed by limiting the amount available to each applicant. The central bank put restriction on demand for accommodation made upon it during time of monetary stringency. In this, central bank discouraged the granting of loans to stock exchange by refusing to rediscount the paper of a bank which have extendable loan, the spectacular. This is an important method of credit control, and this policy has been adopted by a number of countries like Russia and Germany. Second, direct action. Under this method, if the commercial bank do not follow the policy of the central bank, then the central bank has the only recourse to direct action. Direct action may take the form either of a refusal on the part of central bank to rediscount for bank whose credit policy is regarded as being inconsistent with the maintenance of sound credit. Even then, the commercial bank do not fall in line. The central bank has the constitutional power to order for their closure. Moral persuasion. This method is frequently adopted by central bank to exercise control over the commercial bank. Under this method, central bank gives advices, then request and persuasion to commercial bank to cooperate with the central bank is implementing its credit policies. If the commercial bank do not follow or do not abide by the advice or request of a central bank, no gross action is taken against them. The central bank merely was its moral influence and pressure with the commercial bank to prevail upon them to accept and follow the policy. Method of publicity. In modern time, central bank, in order to make their policy successful, take the course of medium of publicity. It's official through newspaper, journals, conference and seminars present a correct picture of the economic condition of the country before the public and gives a prospective economic policy. In developed countries, commercial banks automatically change their credit creation policy. But in developing countries, commercial banks being loaned by regional gains. Even the Reserve Bank of India follow this policy. Fifth, regulation of customers' credit. Under this method, consumers are given credit in little quantity and this period is fixed for 18 months. Consequently, credit creation expands within the limit. This method was originally adopted by USA as a protective and defensive measure. Thereafter, it has been used and adopted by various other countries. Sixth, changes in the marginal requirement on security loans. This system is mostly followed by in USA. Under this system, the Board of Governors of the Federal Reserve System has been given the power to prescribe margin requirements for the purpose of preventing an excessive use of credit for stock exchange speculation. This system is specially intended to help the central bank is controlling the volume of credit used for speculation in securities under the Securities Exchange Act 1934. Quantitative or general method. The method used by the central bank to influence the total volume of credit in the banking system without any regard for the use to which it is put are called quantitative or general method of credit control. This method regulates the lending ability of the financial sector of the whole economy and do not discriminate among the various sectors of the economy. First, bank rate policy. The bank rate is the rate at which the central bank of a country is prepared to rediscount the first class security. It means the bank is prepared to advance loan on approved securities to its member bank. As the central bank is the lender of the last resort, the bank rate is normally higher than the market. If the central bank wants to control credit, it will raise the bank rate. As a result, the market rate and other lending rate in the money market will go up. Borrowing will be discouraged. The raising of a bank rate will lead to contraction of a credit and a vice versa. Open market operations. In narrow sense, the central bank starts the purchase and sale of a government security in the money market. But in the broad sense, the central bank purchases and sells not only government securities, but also of other proper and eligible securities like bills and securities of a private concern. When the bank and the private individual purchases this security, they have to make payment for these securities to the central bank. This gives result in the fall in the case reserve of a commercial bank, which turn reduce the ability of a credit. Through this way of working, the central bank is able to exercise a check on the expansion of a credit. Further, if there is a deflation situation and the commercial bank are not creating as much as credit as is desirable in the interest of the economy, then in such situation the central bank will start purchasing securities in the open market from commercial bank and private individuals. Third, variable cash reserve ratio. Under this system, the central bank control credit by changing cash reserve ratio. For example, if the commercial bank have excessive cash reserve on the basis of which they are creating too much credit, which is harmful for the larger interest of the economy, so it will raise the cash reserve ratio which the commercial bank are required to maintain with the central bank. This activity of a central bank will force the commercial banks to curtail the creation of credit in the economy. In this way, by raising the cash reserve ratio of a commercial bank, the central bank will be able to put an effective check on the bank. The central bank will be able to put an effective check on the inflationary expansion on credit in the economy. Similarly, when the central bank desires that the commercial bank should increase the volume of a credit in order to bring about an economic reveal in the country. The central bank will lower down the cash reserve ratio with a view to expand the cash reserve of the commercial bank.